talking about banks' profitability, it's very hard to ignore what fee income does to driving the bottom line, right? As they say, if your expenses, other expenses and other income are in the same order, and if one could actually maximize fee income as close as possible to the operating expense of the bank, then all of your net interest margin is your profit, right? So in other words, put it simply, fee income is what adds straight to the bottom line. And when we know fee income is actually so critical, I always find it quite fascinating that for most banks that we would have done work with, at least 20 to 30% of what ought to have been collected by them as fee is actually pilfered. The leakage is generally in the range of almost 20 to 30%. And that's for various reasons, right? People would have actually got their system parameters definition incorrect. There may be process gaps in the way they are organized. There may be authority structures that are not well defined. There could be waivers which were meant to be one time that continue to be. So for a variety of reasons, leakage is an area that banks generally would be better off in controlling or minimizing. And the other area that you normally find interesting in a fee income strategy as we build them for banks, besides of course trying to reduce the leakage, is to look for what are the industry benchmarks and where do you peg against the industry benchmarks. Obviously there are corporate fee and retail fee income categories and parameters that are there based on which corporate and retail customers respectively are charged. But if one takes corporate bank, for example, you have fees around trade or treasury or cash in various categories. And when one looks at the fee as compared to what the industry is, and the more the elasticity of the fee, in other words, the distinction between the highest charging, the bank that charges the most and the bank that charges the least actually are at two ends of the spectrum, and where the ends are actually longer, we normally call them as a very high elasticity fee category, and where the distance between the highest charging bank and the lowest charging bank is minimal in the same market, we call it as a low elasticity category. So for example, an LC/LG commission would typically be a low elasticity category, right? What you normally find is the sensitivity of a fee that gets charged is inversely proportional to the elasticity. In other words, the reason why a bank is charging much more than another bank in the same market and customers are willing to pay is because the sensitivity of that higher fee is lesser than what you would have in another category where the distance is much lower. So sensitivity is an important factor. So when we advise banks in driving their fee income structures, we take this into account in driving elasticity and sensitivity appropriately. Of course, when it goes to the retail fee income categories, it's about how you align it across channels, how do you drive it across segments, the operative charges, and it's generally not only about products and services, but it goes beyond that, right? The last point on maximizing fee, it's generally not so much necessarily about driving all kinds of categories of fees and actually fleecing all the money from your customers. You really find customers actually finding it more attracted to banks that are keeping their fee structures simple, that actually are transparent as much as possible and not having anything hidden between the lines. And when you drive a fee income, as a strategy, you got to also distinguish between what is actually being driven from a regulatory standpoint, and there are compliances that need to be kept in mind. And there are obviously areas that you could do only on the basis of where technology helps or allows one to actually do. So to summarize, if you want to have a great successful fee income strategy, then you got to actually minimize leakage, and that's fundamental. And two, you have to be well aligned with the market benchmarks and not be If you're way above your peers, then you obviously are discouraging your customers from engaging with you, and if you're too low, then you obviously are leaving money on the table. And what happens if you got this right? As they say, fee income is straight to the bottom line. So unless we are getting it wrong, you are likely to actually make the most of your profitability with a good fee income strategy.